Welcome to TalkTickers. We're here to give you the shortcut, the real story behind the numbers.
Yeah, skipping the fluff.
Exactly. And today, we're diving into SPS Commerce. They just had their Q1 Fiscal 25 earnings call.
Right. We listened in, got the details.
So our mission, as always, is to unpack what actually matters from that call, the performance, the strategy, what's coming next.
Okay, let's jump in. The headline is SPS had a strong start to the year. Really solid first quarter.
Give us the key numbers then. What stood out?
Okay, so revenue hit $181.5 million. That's up 21% from last year.
21%, that's quite a jump.
It is. And importantly, recurring revenue. That grew even faster, up 23% year over year.
And recurring is really their core, right?
Absolutely. That's the subscription base. They're now at about 54,150 recurring revenue customers.
Okay. And what does that look like to a customer, the ARPU?
Average revenue per recurring customer, yeah. It's sitting around $30,850.
Got it. And profitability, how did adjusted EBITDA look?
Also strong. Came in at $54.4 million. That's up 22% compared to Q1 last year.
So good top line growth, even better recurring growth, and solid profit increase. Seems like a good report card overall.
Yeah, definitely paints a positive picture for the quarter.
That 23% recurring revenue growth, though, is that just more customers signing up, or are they getting more out of the ones they already have? What's the mix there?
Well, it's a bit of both, which is what you want to see, really. New customers definitely help, but that strong growth rate suggests existing customers are, sticking around and maybe using more services.
Expanding their usage.
Exactly. Adding modules, increasing volume. It points to a pretty sticky platform, which is obviously good news for them.
Okay, so let's dig a bit deeper. There was a pretty big event this quarter, the Carbon6 acquisition. That closed in February.
That's right, February. And yeah, it made a noticeable impact right away.
How big an impact?
It brought in about 8,500 customers, added them straight to the tally in Q1.
Wow, 8,500. Was that expected?
Actually, it was a bit more than they initially thought. So, maybe the integration is going smoother or faster than planned, at least in terms of just getting those customers counted.
Interesting. So that's a big chunk of inorganic growth. What about organically? If you strip out Carbon6, how did they do just growing the old-fashioned way?
Yeah, good question. Organically, net adds were around 300 customers in the quarter.
Okay, 300. And where did those come from, mainly?
Mostly from what they call their community enablement programs.
Right. Can you remind us what those are exactly?
Sure. Think of it like a big retailer wants all their suppliers to connect electronically through SPS. SPS helps onboard that whole community.
Got it. So it's like a network effect driver.
Exactly. And what was interesting this quarter, within those programs, the growth was tilted more towards brand new customers signing up for SPS.
As opposed to
last year, where more of the growth in those programs came from existing SPS customers just expanding their connections or usage.
So a slight shift in the dynamic there, pulling in more fresh faces this time around.
Yeah, it seems like their strategy for attracting totally new clients via those community pushes is working well right now.
Now, Carbon6, you mentioned it's in revenue recovery. Sounds intriguing. What exactly is that? And why is SPS moving into that space?
Right. So revenue recovery is basically about helping suppliers claw back money they might be losing. Think deductions from retailers, chargebacks, pricing errors, that kind of thing. It gets complex.
Ah, okay. Stuff that falls through the cracks.
Precisely. And often it adds up to real money.
Yeah.
So by buying Carbon6, and they bought SupplyPipe before that too, SPS is building out this capability to help suppliers, especially the ones dealing with big global retailers, plug those financial leaks.
So it's a complementary service to their core EDI and fulfillment stuff.
Yeah, a very valuable one for suppliers. High potential ROI.
Okay, shifting gears a bit. We hear a lot about global trade tensions, tariffs. Did management say if that's impacting their business, especially those enablement campaigns?
It's interesting. They said for Q1, they didn't really see any significant impact. Campaigns went ahead as planned.
So maybe they're somewhat insulated?
Well, yes and no. They did say they're keeping a very close eye on it. Tariff uncertainty, trade dynamics. It could affect customer behavior down the line.
Right. So stable for now, but watching closely makes sense.
Exactly. These things can take time to filter through supply chains.
Did any part of the business show weakness?
The analytics segment was down slightly, about 2% year over year.
Analytics. Why would that be?
Management sort of expects it to be roughly flat for the whole year, maybe improving a bit in the next few quarters. But yeah, that segment is seen as a bit more, let's say, discretionary.
So if there's economic uncertainty, maybe big analytics projects get put on pause.
That's the idea. Things like tariffs, general economic jitters, they can make companies more cautious about spending on deep data dives, even if they're valuable long term.
Okay. But despite that little dip in analytics, they hit a pretty major milestone, didn't they?
They did. 97 consecutive quarters of revenue growth.
97, that's over 24 years.
Yeah, it's quite the streak. Really speaks to the essential nature of what they do.
What do you think underpins that kind of consistency? It's pretty rare.
Well, fundamentally, businesses need to exchange data and documents in their supply chains. It's not optional.
Right, it's core plumbing.
Exactly.
Yeah.
So there's a baseline demand. Add to that their network effect, the stickiness we talked about, expanding services like revenue recovery. It all adds up to that long-term track record.
Okay, looking forward then. What did they guide for the rest of the year and for Q2 specifically?
All right. For the full year, fiscal 25, they're projecting revenue between $758.5 million and $763 million.
Which is roughly?
That's growth of about 19% to 20% over 2024.
Still pretty strong growth then.
Yeah.
And bottom line, adjusted EBITDA.
Full year adjusted EBITDA guidance is $229.4 million to $232.9 million. That's up 23% to 25% compared to last year. So margin expansion expected too.
Okay, and nearer term for Q2.
For the second quarter, they're looking at revenue of $184.5 million to $186.2 million. That's year-over-year growth of 20% to 21%.
Keeping pace.
Yep. And Q2 adjusted EBITDA between $53 million and $54.5 million. So the momentum seems set to continue based on their forecasts.
We mentioned tariffs and trade uncertainty. Did they talk about any other maybe positive trends emerging from all this complexity?
Yeah, actually, management highlighted that this whole environment might actually increase the focus on supply chain visibility and agility.
So the uncertainty could actually be a tailwind.
Potentially, yes. Retailers and suppliers realize they need more robust, transparent, flexible supply chains to cope with disruptions. And SPS's tools, well, they help provide that.
Makes sense. If your supply chain is suddenly riskier, you want better eyes on it.
Exactly. Better data flow, better collaboration. It plays right into their strengths.
And speaking of strengths, what about the synergy between the core business and these new revenue recovery services from Carbon6 and SupplyPipe? Are they seeing signs of that working?
They said the early signs are positive. Cross-selling opportunities are starting to emerge.
So the fulfillment sales team finding leads for the revenue recovery team and vice versa.
That's the idea. They mentioned qualified opportunities being shared between the teams. It's early days, but it suggests they can leverage that big existing customer base to sell the new services into.
One other detail from the financials. They beat expectations on earnings per share, EPS, in Q1 quite nicely, but the full year EPS guidance wasn't raised by quite as much. Any reason given for that?
Yeah, they addressed that. It basically comes down to the timing of planned spending.
Investments.
Right. They had a strong Q1 profit-wise, but they plan to ramp up investments, hiring, maybe R&D, through the rest of the year.
So investing for future growth, which holds back the full year EPS uplift a bit compared to the Q1 beat.
Exactly. Standard practice when you're funding growth initiatives.
Thinking about supply chains globally, it's kind of interesting. They said most of the traffic on their network is actually domestic U.S., even if the goods started overseas.
Yeah, that's an important point.
How does that play out if tariffs really bite and companies start shifting sourcing, say, away from China to Vietnam or Mexico or even back to the U.S.?
Well, SPS seems to think that could actually be an opportunity. If retailers suddenly need to onboard a whole bunch of new suppliers quickly.
They need a platform to connect them all.
Precisely. And since SPS has such a strong position, especially domestically, they could be the go-to partner for managing those transitions. It could actually boost their community enablement activity.
Interesting angle. And are they just waiting for that, or are they involved in broader industry stuff too?
No, they're active. They mentioned working with groups like the Food Industry Association Supply Chain Forum.
Doing what?
Exploring things like collaborative supply chain performance scorecards, using their network data, to help the whole industry benchmark and improve.
So positioning themselves as a data hub and thought leader too.
Seems like it. Leveraging that unique view they have across so many trade entrepreneurs.
So summing up the core picture, despite the macro noise, the fundamental need for what SPS does seems solid.
That's really the main message. Automation, efficiency in the supply chain, those remain priorities for businesses, tough economy or not.
And their pricing model helps there too, right?
Yeah, because their main fulfillment product isn't priced based on the dollar value of goods, the GMV. It's more based on transaction volume or connections.
So if retail sales dip, it doesn't automatically hit SPS's revenue quite as hard.
Right, it gives them some resilience. They also touched on the de minimis exemption potentially expiring for imports.
Oh, yeah. The rule letting small packages come in duty-free mostly impacts direct-to-consumer from overseas, right?
Yeah, especially maybe some Amazon Marketplace sellers. But SPS believes most of their third-party sellers on Amazon bring goods into the U.S. in bulk containers first, not small packages.
So they don't expect a huge impact on their specific customer base from that potential change.
So that was their take, yeah. Minimal anticipated effect for them.
Okay, lots to digest there. Strong quarter, strategic acquisitions, betting in, navigating uncertainty.
Yeah.
Which brings us to our favorite segment. This is not financial advice. All right, let's try and connect some dots here. We've got SPS doing well in supply chain tech, moving into revenue recovery. We've got global trade making supply chains potentially more complex, maybe driving demand for visibility, but also some economic sensitivity in areas like analytics.
Okay. Where are you going with this?
So here's a thought, maybe a bit out there. How about this? You go long on a basket of boring, old-school logistics and freight forwarding companies.
One's actually driving the trucks and sailing the ship.
Exactly. Because if trade routes get messy due to tariffs or geopolitical stuff, companies might actually need more help from these guys just to figure out how to move stuff physically. Demand for their expertise goes up, even if overall volume fluctuates.
Complexity premium for the established players. Okay.
Yeah.
What's the other side of the trade?
The other side. Acknowledging the growth in supply chain tech like SPS, you pair that long logistics bet with a short position in some super hyped, super early stage, maybe blockchain-based supply chain visibility startup.
Ooh, taking a shot at the new kids on the block.
Kind of. It's a bet that in times of actual disruption, companies rely on the established physical movers, improved tech like SPS, while the more speculative, unproven tech platforms might struggle to gain traction or funding. Betting on the tangible, shorting the hype.
Contrarian, definitely.
Yeah.
Playing the potential disruption through the old guard while hedging against unproven tech promises is plausible in an outrageous kind of way.
That's the spirit. Remember, absolutely not financial advice. Just a wild idea sparked by the call.
Duly noted. So that wraps up our deep dive on the SPS Commerce Q1 FY25 earnings call.
Yeah, we hope breaking it down like this gave you some useful context beyond just the headlines.
Lots going on there, the core growth, the acquisitions adding new dimensions, how they're watching the trade situation.
Definitely plenty to think about. What stood out most to you? Is that revenue recovery pushed the biggest long-term story? Or is it just about executing on the core fulfillment network?
Good questions to ponder.
Let us know your thoughts. Thanks for tuning in to TalkTickers.